Imagine a scenario that sounds almost absurd. A weapon that costs only a few tens of thousands of dollars can force the largest economy in the world to spend millions of dollars just to defend against it. If that happens once, it may not be worth noticing. But if it happens hundreds of times, thousands of times, even tens of thousands of times, the story becomes completely different. At that point, the issue is no longer military. It becomes an economic problem. And in that problem, the side that spends money faster will be the side that loses. This is exactly where today's story begins. Not with a battle on the battlefield, but with a battle on a cost spreadsheet throughout the 20th century, especially during the Cold War. Military power was defined by things that were easy to see: massive aircraft carriers, strategic bombers, missile defense systems worth billions of dollars. Countries competed by building weapons that were bigger, more complex, and more expensive. It was the era of symbols of power. When a nation wanted to prove its strength, it did not need to fight for real. Showing the world its giant weapons was enough to create deterrence. But the world of the 21st century is changing quietly. Modern conflicts are no longer only about who has bigger weapons. Instead, a more important question is slowly emerging. Who can force the opponent to spend more money in this conflict? In economics, there is a concept called asymmetric strategy. It happens when one side does not try to compete directly with a stronger opponent, but instead finds a way to change the rules of the game. Instead of attacking the opponent's strength, they attack the opponent's cost structure. This means that instead of trying to be stronger, they only need to make the opponent spend more. To understand this clearly, think of a simple example. If two people play a game where one person must spend $10 each round while the other must spend $500, the result is almost decided from the beginning. The one who spends $500 each round will run out of money first. There is no need to win every round. You only need to keep the game going long enough. This is exactly the logic that is starting to appear in modern conflicts. And in many cases, the most important weapon is not the strongest one, but the cheapest one that can create the highest defensive cost. In recent years, drone technology has completely changed the way countries think about warfare. Small drones can be produced at a much lower cost than traditional weapon systems. More importantly, they can be manufactured in large quantities. When a weapon can be mass-produced at low cost, it creates an entirely new advantage, the advantage of scale. Pause for a moment and think about this from an economic perspective. If one country can produce hundreds or thousands of cheap weapons, while the opponent must use expensive defense systems to stop them, every act of defense becomes a major expense. Over time, the cost of defense can rise much faster than the cost of attack. This is exactly why many economists and military strategists today have started talking about a new concept: financial attrition warfare. In this type of war, the goal is not to destroy the opponent's army immediately. The goal is to force the opponent to spend more and more money to maintain its defense system. When defense costs become too high, pressure begins to appear in other parts of the economy. The national budget has to increase military spending. Other sectors may be cut. Financial markets begin to react to new risks. In other words, the war does not only take place in the sky or at sea. It takes place on the balance sheet of an entire nation. What makes this story especially interesting is the fact that the global economy today is more interconnected than ever before. When a large country has to sharply increase military spending or face geopolitical risk, the impact does not stop at its borders. Energy prices may fluctuate. Stock markets may react. Global supply chains may be affected. So when we talk about a strategy that forces a superpower to spend more, we are not only talking about a military issue, we are talking about a global economic issue. In this video, we will not look at this story from the sensational angle of war headlines. Instead, we will analyze it as an economic problem, a problem involving costs, energy, financial systems, and the flows of money that keep the world economy running. The question we are going to explore together is very simple, but it can lead to extremely deep conclusions. What would happen if, in a modern conflict, the side that wins is not the one with the strongest weapons, but the one that makes the opponent spend money the fastest? To answer that question, we need to start from the foundation of this entire system, the cost structure of modern warfare. And when you look closely at that structure, you will notice something very interesting. Sometimes, a small, cheap, and simple weapon can create financial consequences far greater than those caused by massive weapons worth billions of dollars. That is when the real war begins. Not with gunfire, but with a calculation, part 1, when war becomes a budget problem. If the previous section showed that modern warfare can be decided by cost mathematics, this part goes deeper into a more important question. Why even a military superpower can still be placed at a disadvantage in that cost equation? To understand this, we have to look at a factor that is rarely mentioned in war reports: the economic structure of the defense industry. For more than half a century, the United States has built the largest military system in the world. Its annual defense budget usually ranges around $800 to $900 billion, higher than the combined military spending of many major countries. This number does not only reflect military strength, but also a massive economic ecosystem behind it: defense corporations, high-tech supply chains, and advanced weapons research programs. The problem is that this system was designed for a completely different type of war. During the Cold War, the main opponent of the United States was the Soviet Union. Both sides possessed nuclear weapons and could not attack each other directly without risking global catastrophe. Therefore, the main strategy was deterrence. Each side built larger and more complex weapon systems to send a clear message any attack would be extremely costly. The result was a military model focused on 3 factors: high technology, large scale, and very high cost. Systems such as aircraft carriers, stealth aircraft, and missile defense networks were designed to deal with nation-scale threats. They are extremely powerful, but also extremely expensive. And this is exactly where the economic problem begins to appear. In traditional warfare, if both sides use weapon systems with similar costs, the balance of power usually depends on technology and tactics. But when one side starts using weapons that are much cheaper, the entire cost structure changes. Look at a simple example. A modern missile defense system may have to use interceptor missiles worth from $1 to several million for each launch. Meanwhile, small attack vehicles, such as drones, can be produced at a much lower cost. If there are only a few attacks, this difference may not matter much. But if attacks happen continuously and in large numbers, the cost of defense will begin to rise exponentially. This does not only put pressure on the military budget, but can also create wider financial consequences. Military economists call this financial attrition strategy. Instead of trying to destroy the opponent's entire military power, the goal is to force the opponent to spend more and more to maintain its defense system. Over time, that cost can become a burden on the national budget. What is notable is that this strategy does not need to achieve immediate military victory. As long as it creates enough financial pressure over a long period of time, it can weaken the opponent's ability to sustain its power. Another factor that makes this equation more complex is the flexibility of low-cost weapons. Simpler technologies can often be produced quickly, upgraded easily, and deployed in many different locations. In contrast, large defense systems usually require complex infrastructure and longer deployment time. This creates an important asymmetry. One side can attack at low cost and in large numbers, while the other side must maintain expensive defense systems to protect many targets at the same time. From an economic perspective, this is not only a military competition, it is more like a war of cost efficiency. The country that can achieve its strategic goals at a lower cost will have the long-term advantage. And when we look more broadly, his story connects to an even larger issue: how superpowers manage their resources. An economy can be very strong, but if the cost of maintaining its security system rises too quickly, financial pressure will gradually spread to other sectors. History has shown many examples of this. In many cases, empires did not weaken because they were defeated directly on the battlefield, but because they could not sustain the cost of the power system they had built. That is the key point of this section. In the modern world, military strength is not measured only by the number of weapons or the size of the army. It is also measured by the ability to sustain the cost of that entire system over a long period of time. And when we begin to look at geopolitical competition from this angle, an important question starts to appear. If war truly becomes a contest of cost, then what factor in the global economy will determine who can stay in the game the longest? To answer that question, we have to move to another factor, even more important than the military, energy, and the flow of oil money. Because for many decades, this source of energy has helped sustain the financial strength of the global economic system. And when that flow is disrupted, its impact can spread farther than any military conflict. Part 2. The flow of oil money, the real foundation of financial power. If the previous section showed that modern warfare can become a battle of budget attrition, then to understand the bigger picture, we must look at a factor even more important than weapons: the flow of global energy money. For more than half a century, the world economic system has operated around a very special axis. That axis is not only technology and not only trade, that axis is oil and the United States dollar. After the energy market shocks of the 1970s, a special financial mechanism gradually formed. Major oil exporting countries in the Middle East began selling oil mainly in United States dollars. This created an extremely important economic consequence. Any country in the world that wants to buy energy needs dollars. This turned the United States dollar not only into a national currency, but into the central currency of the global energy system. When countries buy oil with dollars, the money flow does not stop there. Oil exporting nations, after receiving large amounts of dollars, must decide what to do with that money. And for many decades, a large portion of that capital has flowed back into the United States financial market. In economics, this phenomenon is called petrodollar recycling, the reinvestment cycle of oil money. The mechanism is simple but very powerful. Oil exporting countries sell energy to the world and receive large amounts of United States dollars. Then that money is invested in many types of financial assets, from United States government bonds to shares of major corporations. As a result, the flow of money from global energy continuously moves into the United States financial system. This creates a double effect. First, demand for the United States dollar remains high because it is the currency needed to buy energy. Second, the investment capital that returns to the United States financial market helps maintain liquidity and supports the value of many assets. In reality, many large investment funds from Gulf countries are currently managing trillions of dollars in assets around the world. A significant portion of that capital is allocated to technology and financial companies in the United States. As these capital flows continue to enter the market, they help sustain the strength of financial centers, such as Wall Street. However, What makes this system sensitive is that it depends on the stability of the energy-producing region. The Persian Gulf region is home to some of the largest oil exporting countries in the world, including Saudi Arabia, the United Arab Emirates, Kuwait, Qatar, Bahrain, and Oman. These countries are often mentioned together in a regional economic cooperation organization. From the perspective of the energy market, this region acts as a major supply center for much of the world. From the perspective of the financial system, it is also a source of enormous capital flows that return to global markets. Because of that, any major disruption in this region can create a chain reaction. If energy supply is disrupted, oil prices can rise sharply. This immediately affects the operating cost of the global economy, from industrial production to transportation. But the impact does not stop at energy prices. When oil exporting countries face geopolitical instability, their priorities may change. Instead of investing abroad, they may need to focus resources on security, domestic economic stability, and the protection of energy infrastructure. That means global investment flows may change direction, and this is exactly the point where many economic analysts begin to ask an important question if the petrodollar cycle is disrupted. How will the global financial system react? The answer is not simple, because modern financial markets are a complex network. But one thing is almost certain. When large capital flows change direction, asset markets cannot remain unchanged. Global investors closely watch regions that can affect energy supply, because when energy moves, almost every sector of the economy moves with it. In other words, energy is not only fuel for vehicles or factories, it is fuel for the entire modern financial system. Therefore, when analyzing geopolitical strategies related to the Middle East, the important question is not only who controls territory or who has stronger weapons. The more important question is who can influence the flow of energy and the flow of money that comes with it. Because when those flows change, the impact will not stop in one region. It can spread across the entire world economy. And it is at the intersection of energy, currency, and financial markets that the global geopolitical picture becomes far more complex. This leads us to the final question of the video: if these systems begin to change, what will the future global economic order look like? Part 3. The real game: energy, currency, and the global economic order. When we look at the full picture, we begin to see something very clearly. This story is not only a military issue or a regional conflict. What is on the table is not just territory or military strength, but the structure of the global economic system in the modern world. Three elements are more tightly connected than at any time in history: energy, currency, and financial markets. Any major change in one of these three can create ripple effects across the entire system. Let us begin with the first element: energy. Oil and gas are still the foundation of the global economy. Even though the world is gradually moving toward renewable energy, most industrial activity, transportation, and production still depend heavily on fossil fuels. This means that regions controlling large energy supplies always have special influence over the world economy. When energy supply is stable, economies can operate smoothly. Energy prices remain predictable. Production costs stay stable, and businesses can plan for the long term. But when energy-producing regions become unstable, the global economic system almost immediately feels the pressure. Rising oil prices push transportation costs higher. Higher production costs lead to higher prices for goods. Inflation begins to appear across many sectors. Central banks are forced to adjust monetary policy. Financial markets react to uncertainty. All of this can happen simply because of a shock in energy supply. The second element is currency. For many decades, The United States dollar has played the central role in the international financial system. Most global trade transactions, especially energy trade, are priced in dollars. This creates a vast financial network in which trade flows and investment capital often return to the United States financial system. But the global monetary system is not a fixed structure. In recent years, many countries have started discussing the diversification of the international payment system. Some nations are looking for ways to use more currencies in bilateral trade, especially in the energy sector. These changes do not happen overnight. However, they reflect the reality that the global financial system always evolves, along with geopolitical and economic shifts. The third element is the financial market. Today's global financial market is more interconnected than ever before. Investment funds, banks, and multinational corporations constantly move capital between different markets to seek profit and manage risk. When a major economic region faces instability, capital flows can change direction very quickly. This means geopolitical fluctuations do not affect only one country or one region. They can create waves that spread across the entire financial system. When we combine these three elements, energy, currency, and capital flows, we begin to understand why geopolitical competition today can have such far-reaching effects. What is happening in the world is not just a series of isolated conflicts. It is more like a chain of games being played at the same time on different boards. One board is about energy security. Another board is about the monetary system. And another board is about global capital flows. In many cases, the outcome of these games is not decided by a single event. Instead, it is shaped by a long series of economic, political, and strategic decisions made over many years. That is why, when we follow geopolitical changes around the world, it is not enough to look only at surface events. What matters more is understanding the economic systems operating behind those events. Because in the 21st century, the strength of a country is not measured only by the number of weapons or the size of its army. It is also measured by the ability to control the most important flows of the global economy: the flow of energy, the flow of currency, and the flow of investment capital. And when these three flows begin to change, the world economic order may change with them. That leads us to one final question, a question that no one can answer with certainty right now. In the coming decades, will the global economic system continue to operate under the current structure? Or are we entering a larger transition where new centers of economic power begin to appear? The answer to that question may not come in a day or a year. But what is happening today may be the first steps of that change. And in a world that is becoming more complex, understanding the economic forces behind global events may be one of the most powerful tools any of us can have.